Hello. In this video, I want to talk to you about what it is that I expect you to cover in your operating cash flow, terminal value, cash balance estimates presentation. So I'm providing this as an example of what your presentation might look like and how you might talk about it briefly. Um, you still are going to need to remind people of your business concept and go over, and include your revenue forecasts. But you don't need to talk to those like you did in the first presentation. To the extent that maybe something in the first presentation changed, and so now you are making some revision, you would want to draw attention to those and make sure that everybody understands that those have changed. Otherwise, you would simply go through the business concept very quickly, maybe a minute. The revenue forecast, you just show the charts for a second and say, again, here are the revenue forecasts. You'll see that they haven't really changed, or if they have changed, you would explain how. The main focus that you're talking about here are your operating cash flow forecasts. Again, the assumptions, the forecast, the terminal value, all that sort of stuff. And so I'm going to go through these because nothing changed. So as it relates to our operating forecast, cash flows, break your forecast, your discussions of assumptions down in the same way you did in building them. So we would talk about costs first, variable costs and period costs. I have variable costs, food and beverage, 25% of sales, direct labor, 25% of sales. Whatever assumption you make here, you need to cite some support for it. In my case, I did research looking at information on the internet about restaurants and what their typical variable costs are, and these were the two categories that came up. And I did research on what the food and beverage versus direct labor costs are. These numbers are consistent with that, kind of in the middle of that range. I will tell you the labor costs showed up as two different ways, one in sort of a 25% range, the other in a 35% range. And the reason for that is that on some sites they cite all-in labor cost, both direct and indirect, and in others they don't. The direct labor costs generally are about 25%. That includes waiters, cooks, people that on a day-to-day basis you can adjust how much you pay them. They're generally hourly employees, so you can adjust your pay and budget to that based on your sales. Indirect labor generally has to do with administrative and management. And so usually those are either salaried people, or if they're not salaried, they are still people that there's an amount of work that needs to be done every day regardless of what the sales are. And typically we're looking at about 10% of what we would call sort of steady state amounts. So once your business is kind of up to full speed, how much that would be. And so I took the year two sales number because by that point in time, we've sort of smoothed everything out and got our growth spurt out of the way, if you will. So took that Y2 sales number and based it on that. Occupancy, we assumed 3% of sales. Really hard to find good occupancy numbers, probably because the cost of buildings and rentals and so forth varies from place to place to place. What we have done, though, is we have not included lease costs here because we're going to purchase the building and the land. And so the occupancy costs for us really are things like the utilities and upkeep of the place, that sort of thing. Based it as 3% of year two sales. That's actually a pretty big number. It's like 60,000 a year. Works out to about 5,000 a month, which seems like a very comfortable number for a single unit in this area. If anything, we probably overestimated those. Equipment repairs also did 3% of Y2 sales. We're using, again, sort of this percent of sales approach. Again, comes out to about 60,000 a year. In this case, what I really wanted to compare that up against to see if it made sense was the amount that we assumed that we would need for kitchen equipment, tables, chairs, all that sort of stuff, which based on sort of industry um, standards looked to be about $200,000. And so this really represents that sort of every year we would spend 30% of the total cost of equipment in repairs and replacements. Again, that sounds really high to me relative to that base, but I would rather include that in here and be a little bit off for now. If we find out that being so aggressive in terms of our costs, which gives us really conservative cash flows, if we find that that makes this a deal breaker, we might want to tighten up on those just a little bit. But for now, I'm more comfortable leaving that pad in. And then I included a category called Other. I saw this miscellaneous category, or quite frankly, saw all sorts of different smaller sorts of period costs. These three that I've listed are really the big ones. So this was sort of a catch-all for all of those, and that winds up being like 100,000 a year in that miscellaneous. And I would obviously like to include that in the analysis to be conservative, but that represents a good example of a place where management can sort of intervene and work to scale back that spending if they can. So in practice, we may see that the results are quite a bit lower than this. Certainly wouldn't expect them to be higher than this. In terms of assets, did a review of real estate in the area, commercial real estate, to get an idea of kind of square footage for restaurants and parking space and all that, and what pricing would be over near the campus, and came up with a $1 million price tag. I actually think that probably is a bit of an overestimate as well, but wanted to be safe. That value has to be split between land and building for depreciation purposes. When you buy the thing, assuming we're either going to buy a lot and build a land on it, or we're going to buy the lot and the building, all together, and then have to do the rework on the building. So, but when you buy it, you just buy it as a lump sum number. But you have to, for tax purposes, you have to split that out. And what we did was assume, usually you just do it on a percentage basis. We assumed that the land was 40%, the building was 60%. Now, in reality, 40% is usually the high end of where land is. It's somewhere between 20 and 40, which means that building's 60 to 80%. But the way this works is the more that we attribute to the building, more value that we attribute to the building, the more we can depreciate this from an IRS perspective. And what I wanted to do here was make a conservative assumption in terms of our overall cash flows. So having a lower building value means that we can take less depreciation, which means that we get less tax benefit from the depreciation, and our taxes are higher in this assumption, this analysis. So again, another conservative assumption. If we find that is important in the final valuation, we could relax this down to say 30/70 or even 25/75 and probably still be pretty comfortable with it. Equipment, I did on a percent of sales basis, 10% of year two sales, which came out to about 200,000. That includes the kitchen equipment, tables, chairs, fixtures, dishes, etc. I will be honest with you, probably if you wanted to go out and buy all of that stuff brand spanking new, that probably is a reasonable number, maybe even a little bit low. But quite frankly, experience tells me and tells others that buying brand new equipment for everything in your kitchen is probably not the best idea for a startup business. You're better off buying something that's used and replacing it with new maybe a little bit later on. The other thing that I think you got to keep in mind here is a lot of times if, let's say, you were going to go build a new building, part of the cost of the build out is things like walk-ins and all, air conditioning, all those sorts of things, and it's already put into the building cost. And so there's some overlap between these two probably in the initial build out, or however that works out. And then lastly, keep in mind that we do have that $60,000 a year budget for either buying new stuff or whatever. So one of the things that we could envision is sort of budgeting ourselves to an amount in the first year that stays around this $200,000, with the idea that we have built into our operating budget the ability to replace old equipment with new equipment, or buy additional fixtures and chairs and tables and so forth if we needed to. So I think we can manage to this pretty reasonably. Depreciation, this is not something you get to just pick. You have to go look this up. I looked at the IRS websites. Buildings, generally depreciable over 30 years. Restaurant equipment, 5 or 7 years, kind of depends on the durability of it. Most of what we're talking about here is 7 years. Here's the deal. The IRS would allow us to do what's called an accelerated depreciation on both sets of assets here. And that means that you could charge a higher depreciation expense in the early years and have that kind of drop off towards the end. That would have the effect of basically reducing our tax burden in the early years and having it go up in the later years. It's favorable to do, and in the actual running of the business, we would likely do that. However, for these purposes, we've just done a simplification, what we would call a straight line depreciation, and that means that the amount that you depreciate each year over the period is the same amount. So, for example, the building, if we're going to depreciate it over 30 years, you would take 1/30 each year as depreciation. So our building, I think we said 600,000. So 1/30 of that would be 20,000. We'd take 20,000 a year in depreciation, and the equipment we'd take 1/7 each year of that 200,000 roughly as depreciation. And again, this is probably it's conservative in the sense that it's going to make it look like our taxes are a little bit higher. And in the long run, I think when we actually do this, and we'll have the accountants do it properly, and we'll get the benefit of that in the early years. But it's a complex process to do. I don't know that it changes our valuation decision that much. We might want to think about it if it's a really marginal project. But initially, that's just another place where we could point to and say, if anything, we have underestimated what our actual operating cash flows will be because we overestimated taxes. And so then we go to the taxes. Always the fun part of the analysis. Looked up a few things here. We will obviously have property taxes because we buy property. And Alabama Department of Revenue says that the taxes on property, land, and building type stuff is approximately 7.5% of the assessed value of land and buildings. And then what they do is, depending on what the use of the property is, they assign the assessed value as being some percentage of the market value. And so in our case, we're looking at $1 million market value, but because it's commercial property, the assessed value is only 20% of it. If it was your personal property, it'd only be 10% of it. But at 20%, that means that we're calculating taxes on a $200,000 property value, assessed value. And so that's just it's not going to be a real big number. That's good news. The Alabama business privilege tax is charged against taxable income, basically, net of the property taxes, net of any depreciation that we calculated. And it's very small. It's actually 0.125% of the business cash flows, what you would normally think of as taxable income. And so winds up, again, not being a very big number. The Alabama corporate income tax, that does exist. It's 6.5% of the business cash flows. You again get to deduct off property taxes and depreciation before that. You don't get to deduct off the business privilege tax first, but it wouldn't matter that much. I want to make a point about this. It is a corporate income tax. And so you have to be a corporation and not a limited liability corporation, an LLC, but an actual C Corp in order to have to pay these taxes. And so there is a decision that we would have to make about whether we want to organize this as a corporation or as a sole proprietorship partnership, LLC taxed as a partnership, S corporation. There's all sorts of these different choices that you could make that would have different tax implications. This is the most costly of them because you would have to pay this corporate income tax, and then if people got distributions, they'd have to pay personal income tax on it too. If you were to choose any of the other organizations, you would not actually pay the corporate income tax, and so the business would not pay any taxes, but the individuals would be responsible for paying 6.5% of their share of whatever the business cash flows were. This kind of makes it neutral to the decision if I just include it in here. Key thing for you to understand about how that works. The personal income taxes for what they call pass-through organizations like sole proprietorships and so forth are such that it doesn't matter whether the business actually writes you a check and distributes the cash from their bank accounts to your bank accounts. It is the amount of earnings, taxable earnings that they earned over the year that gets distributed to you and that you have to pay taxes on. So you can't game this by saying, well, I won't pay the taxes this year, I'll just leave the money in the business. You can't do that. Whereas with the corporate income tax, the corporation, of course, pays the 6.5% every year. And then they can decide when they're going to distribute money to you. And you only have to pay any additional taxes when they distribute the money to you. And so there is, some a little bit different treatment there. Then there's the federal corporate income tax. Again, the only difference between this and the state corporate income tax is that you get to deduct the state taxes, the business privilege tax and the corporate income tax for Alabama. You get to deduct those off basically before you figure out how much you owe for federal taxes. And that way they don't double tax you on that amount. I had initially assumed in the calculations that I had done a 25% value on this. The deal with federal income tax is that the amount, kind of the effective tax rate, is different depending on how much income you have. And so the lowest tax bracket's about 15% and goes all the way up to 40% at one level, and then starts dropping down to, I think, 34%. And so without knowing in advance kind of where we were going to wind up in terms of earnings, it was hard to know what to assume in terms of the taxes. Once I got through the calculations and saw kind of what the annual income was going to be, I felt a lot more comfortable with 35% than I did with 25%. And so that's what I did. And since we built our spreadsheet dynamically, all that took was I just had to go into that one cell where I had that tax rate, change it. Everything changed and I'm all good to go. So to be clear, these values you're going to see are based on a 35% tax rate. I cannot imagine the effective tax rate will be any higher than 35%. It might be a little bit lower, and so again, this would be a conservative assumption for the analysis. So let's look at the cash flows, and I'm going to show you two views of it. Here's the after-tax cash flows. Does not include the initial investment outlay. If you added up the equipment and the building, we're looking at about a $1.2 million initial investment outlay, right? And so this one doesn't include it, but this one does. All right, and I show them differently because that's the only difference between them, but because this is so big, it makes all these others real small and you can't see what's really going on there. So you can see, in the early months, before we open, we're going to have a sizable cash outlay getting open. And then in the early months, we're gonna not have big after-tax cash flows. They're going to start kind of peaking, and then that's when the end of the semester happens, there and there. They're going to go negative in January, quite frankly. We just don't have enough going on. We've got too much cost going on there. And then starting in February, they're going to start going back up. March, April, May. They'll drop again, obviously, in June and July. And then you get to August, I guess, or early August, and they're going to go negative there. And part of the reason they're going negative there is that's when we have to pay the property tax. So that kicks in. But we have low sales, and that timing wise, that's just when that works out. But so it looks a little bit scary initially, but if you look at kind of what's going on year to year, from year two forward, not so bad. We're looking at that. Each year we're looking at somewhere starting out about 365,000 of positive cash flows. And over time that's growing. You see that in year 8 it kind of dips down and goes back up. What's going on there is that the equipment we fully depreciated after year 7, and so we lose that depreciation expense, and so we have to pay a little bit more taxes starting in year 8, and then it kind of goes back up. But after everything, we're still looking at somewhere around $400,000 a year in after-tax cash flows, operating cash flows, per year by year 10. Now, I also took the year 10 value and calculated a terminal value. I estimated that at $3.2 million. And that's based on a 15% discount rate, 2% growth rate. And so we're just doing the value of a growing perpetuity. And that's what its value is if we were to sell the business at the end of year 10 and say, what would you give us for the business? So think of it as this is what the business could be sold for if we're standing in year 10 and selling it to somebody who's selling it going forward. That's just a rough estimate of that. And we would want to, for valuation purposes, we want to keep that in mind as part of our overall valuation. Last thing I looked at was cash balances, again, because the company needs to always stay positive in terms of the money in their cash account. I thought that was worthwhile. So start out in month 0 with the amount that we assumed would be the initial capital contribution, about $1.4 million. And taking into consideration we're going to spend $1.2 million of that on our assets and consume about another $100,000 of that in costs over the initial opening period before we actually get the business open. We'll still have about $100,000 buffer, which we're feeling pretty good about. And that's not going to grow a whole lot. It's going to grow a little bit over the first few months and kind of go up and down, but it'll start to accumulate. Basically what this is, obviously slow uptake, if you will, for the fall semester, and then you're falling into the winter. But it really starts to pick up as you get the benefits, if you will, of the spring semester where people really know us. And then, of course, you don't get a whole lot of growth and even a little bit of a dip as you go back into the summer. But nonetheless, by then you're up to somewhere around $275,000 in your cash account. So feeling a very good buffer at that point. And by the end of year 2, we would expect that to grow to over $500,000, and we would have somewhere north of $3.5 million in the cash account at the end of year 10 if we just keep all the money in the account. Now, obviously, it doesn't make sense to keep it all in the account, but that's a discretionary decision, how much of it we want to distribute or not. And so I don't put that in here. That's something that you can decide on. Anyway, all in all, at this stage, not knowing the cost of capital, I can't tell you what the value is and whether it's proper to do, but it looks like what we've modeled represents a viable version of the business. So that's what I would hope you guys talk about. All right. Well, so that's me sort of modeling to you what I would hope that you would do with your business. And you need to start working on that and kind of practicing and making sure you can speak to all of these things. I will be asking questions, and you want to do that early You want to get to this point early on, well before the day of the presentation, so that you can come and try things out in class, ask me, all that sort of stuff. Thanks.